$250 billion for an internal corporate shuffle. Tell me I'm missing something here.
You're missing the synergy. Elon is just moving his right pocket into his left pocket.
And charging $250 billion for the privilege. Sullivan and Cromwell must be billing by the microsecond on this.
It totally proves my point about this K-shaped market. Have the AI halo, you get Megadeal money. Legacy software, you're getting crushed.
I completely disagree with your software doom narrative. But fine, show me the actual numbers. The rundown.
Morgan Stanley is finally saying the quiet part out loud about legacy software.
Brutal valuation resets.
Brutal is right. Buyers are walking away from term sheets if you don't have a legitimate AI thesis. The market is fracturing so fast.
It's totally K-shaped. If you're a well-capitalized buyer chasing a mega deal over $5 billion, the money is flowing. Everyone else is basically stranded.
Which makes the mid-market stuff so fascinating right now. Hit me with the rundown.
First up, school bus consolidation. Bluebird just dropped $200 million to buy out Girardin Group's stake and take full ownership of their Microbird joint venture.
Taking full control of a JV is classic cycle cleanup. Also, Microbird sounds like a failed scooter startup from 2018.
Don't give them pivot ideas. Next, Hitachi Rail is buying Clever Devices.
Clever Devices, who is naming these targets this week?
I know, but if you name your transit tech company Clever Devices, your devices better actually be clever. I read the release, it's mostly intelligent tracking for bus and rail fleets. Solid infrastructure play.
I buy that. What's happening in healthcare?
The usual steady churn. Merit Medical is buying Viewpoint Medical for $140 million to beef up their interventional radiology side. Oh, and Lupin officially closed on VISUfarma over in Europe.
Which brings us to the Deloitte note that dropped this morning. They are calling for a massive throttle up in bank M&A for 2026. Volumes already jumped 42.5% last year. The regulatory dam is finally breaking, Maya.
Oh, come on. You always fall for the advisory pitch. A throttle up? Have you looked at the actual approval timelines for financial consolidations?
The regulatory easing is real this time. Regional banks have a massive backlog and they're desperate to merge.
Desperate doesn't mean approved. I'll believe the easing narrative when I see the backlog actually clear. Until then, it's just Deloitte trying to sell integration consulting.
Cynical. But fine, we'll watch the banking space, just like we're watching Gilead's $2.2 billion move for Uro Medicines.
And the $2 billion Novartis is paying for Sinovation.
Which are massive deals in any normal week.
Right. But today those look like absolute rounding errors.
Because Elon just broke the scale. $250 billion.
SpaceX, swallowing xAI whole. I need to see how Sullivan and Cromwell actually structured $250 billion. The big one.
$250 billion? I just need to say the number out loud so my brain actually processes it. 250 billion.
And honestly, it's mostly monopoly money. We're talking about Elon moving assets from his left pocket to his right pocket, but doing it at a valuation that absolutely breaks the scale.
Okay, but you can't deny the strategic logic here. SpaceX needs massive localized compute power for Starshield and the Starlink network. xAI needs infrastructure and capital. Bringing them under one roof makes sense. It's the ultimate vertical integration.
I am denying the logic, Nate. Come on. You don't need $250 billion merger to share compute resources between two companies owned by the same guy. You write a vendor contract. What you're actually doing here is cementing a new floor for AI valuations.
A vendor contract? Maya, you're thinking like a procurement officer, not a world builder. This is about consolidating the ultimate tech stack. Hardware, rockets, satellite internet, and AGI.
I'm thinking like someone who reads the disclosures. Look at the advisors. Sullivan and Cromwell must be throwing a parade down Broad Street right now. Can you imagine the billable hours on structuring a $250 billion related party transaction?
I bet they're trying to figure out how to bill for travel time to low Earth orbit.
Oh, definitely. But look past the headline number. This deal perfectly proves what Morgan Stanley was warning us about this week. The M&A market is entirely K-shaped right now.
Yeah, the mega deal distortion field?
Exactly. You have these massive, well-capitalized buyers doing deals over 5 billion, and then below that, crickets. Overall deal volume is totally flat.
Worse than flat if you're legacy software. I was talking to a buddy at a boutique tech bank yesterday. He said the valuation resets happening behind closed doors are just brutal right now.
Because every corporate development team is pivoting their cash toward AI-enabled tech. Why buy a traditional SaaS platform when you're terrified it'll be obsolete in 18 months? So the legacy guys are getting crushed, while xAI gets valued at the GDP of New Zealand.
Which makes me wonder who the next casualty is going to be in the software space. But honestly, the real story hiding behind this tech drama is what's happening in the regulated markets.
You're talking about the Deloitte report.
Oh yeah, Deloitte is predicting a massive throttle up for Bank M&A. Regulatory easing is finally unblocking the pipes. We have a huge backlog of financial consolidations ready to pop.
Plus, we have some massive pharma deals crossing the wire. Gilead dropping $2.2 billion for Uro Medicines, and Novartis making a $2 billion play for Sinovation.
Let's talk about those bank deals first, because if Deloitte is right, the regional banking map is about to get completely redrawn. Voices. Morgan Stanley put out a note this morning that perfectly captures this K-shaped market we're seeing. They said AI is driving massive demand in manufacturing and utilities, but it's absolutely disrupting legacy software and forcing harsh valuation resets.
Harsh is putting it mildly. I was looking at some of the private multiples being thrown around for legacy SaaS companies right now. It's a bloodbath behind closed doors.
Right, because every buyer is taking their capital and throwing it at AI capabilities. If you're selling traditional workflow software right now, you're basically trying to sell a flip phone in 2008. Nobody wants it unless it's heavily discounted.
I disagree on the nobody wants it part. I think this is exactly what private equity has been waiting for. These valuation resets aren't a death knell. They're a buy signal. You're going to see massive roll-ups of these legacy players now that founders finally have to accept reality.
Maybe, but I still think the smart money is avoiding software entirely right now. Which brings me to the other note that caught my eye. Deloitte is predicting a, quote, throttle up moment for bank M&A this year.
Throttle up. I love when consultants try to sound like Top Gun.
Hey, it works. They're citing eased regulatory uncertainty and a 42.5% jump in deal volumes last year.
Okay, wait. A 42% jump sounds amazing until you remember that the baseline was basically zero. Bank deals were entirely frozen. Going from 2 deals to 3 deals is a 50% jump, Nate.
You always ruin my favorite stats.
I just read the footnotes, but fine. The regulatory easing is real. We do have a huge backlog of financial consolidations waiting to clear.
Speaking of backlogs clearing, we need to talk about what's happening in healthcare tomorrow. Gilead and Novartis are both making multi-billion-dollar plays, and the structures on these are fascinating. Spill the tea. I am telling you, the group chats are a bloodbath right now for legacy software founders.
Good. It is about time. You cannot just slap a .ai on a 10-year-old SaaS platform and expect a 20 times multiple anymore.
Ouch. Tell us how you really feel.
I am just reading the Morgan Stanley note. They are calling it a harsh valuation reset. AI is driving massive demand in places you would not expect, like manufacturing and utilities, but it is actively disrupting the software sector.
Destroying is a strong word, Maya.
I said disrupting. But honestly, look at the data. We have a totally K-shaped market right now.
I love a good letter analogy.
You would? But it is true. If you are doing a Megadeal over 5 billion, the capital is there. Everybody else is fighting for scraps while deal volumes stay totally flat.
See, I disagree that the middle market software guys are fundamentally broken. I think they are just playing chicken. They remember 2021 valuations and they refuse to accept the new reality.
No, buyers are actively pivoting their capital away. Why buy a clunky legacy system when you can acquire AI capabilities directly?
Fair point. And if you want proof of where the real money is going, just look at the advisory fees Sullivan and Cromwell are pulling down for that $250 billion SpaceX and xAI merger.
$250 billion. I still cannot wrap my head around that number.
It is the ultimate upper arm of the K. Meanwhile, down in the trenches, we actually have some movement in the middle market. Merit Medical picking up a Viewpoint for $140 million.
Bluebird dropping $200 million to buy out Girardin Group.
Exactly. Cute, sensible deals, but the real drama next week is not going to be in tech at all.
You are talking about the Deloitte prediction.
Oh yes, the banking throttle up. Regulatory easing is finally unblocking the pipes. So are we about to see a tidal wave of mid-sized bank mergers? Or is everyone going to get distracted by Gilead and Novartis dropping billions in healthcare? Tomorrow's radar. Deloitte is predicting a throttle up moment for Bank M and A tomorrow. Regulatory easing is finally clearing the backlog.
I hate the phrase throttle up. It sounds like a terrible energy drink.
It's what my old MD used to say right before ruining my weekend. But volumes jumped 42.5% last year. The floodgates are opening.
I'm not buying it. Look at tomorrow's docket. Healthcare is where the actual cash is moving. Gilead is closing $2.2 billion for Uro medicines. Novartis dropping $2 billion for Sinovation. Bank mergers are just paper shuffling. Pharma is buying actual science.
Shots fired at the financials desk. Fine, but don't ignore the software bloodbath Morgan Stanley is tracking. AI is forcing brutal valuation resets. Legacy tech is getting absolutely slaughtered behind closed doors.
Which is exactly why I'll be reading the footnotes on tomorrow's software term sheets. Someone is hiding a massive down round.
Find the bodies, Maya. We'll dissect them next time.